Well, thank you all for joining today. I'm Gordon Stone. I'm the Director of the Agribusiness Development Institute and also one of the mentors for the business development program that we also run as part of our overall program for the beef sector, for the sheep sector and for the agricultural sector at large. I'm joined today by Damian. Damian, are you there and how are you?
G'day Gordon, how you going? I'm very well, thank you. Nice to be with you.
Yeah, likewise. Thanks for joining us again, Damien. And for those who are joining on a computer, you can actually see, or are watching the slides that we have, you can see that this is actually a part two discussion around attracting an investor into your business. So I guess just a few introductory and setup remarks. We always preface our webinars on the basis of our objective, which is to work with business owners to create a high-performing, self-managing, saleable and profitable agribusiness. And the reason we're doing that is because that actually creates a discipline around a high-performing operational business that will look after itself. And one of the reasons for that is to get the business owners off the tools, so to speak, and out there thinking about how they can expand their business further, or engaging with customers, or in this particular case, engaging with an investor, which I know, I was speaking to someone this morning who said, that almost sounds a bit far-fetched, but now that we've discussed it, I can see how I can do that. So in August last year, we actually ran a webinar where we introduced some concepts, and we'll actually be covering a few of those today. But the particular focus that we have with this session is to think about the owner themselves, because as Damien will elaborate in a few minutes, it's quite definitely the case that when an external investor, and this also is the case for a bank, are thinking of investing in a company, they look very much at the capability of the business owners. So we felt today that was our key focus. This particular program is also in association with the Beef Business Mentoring Program, which, as you can see on slide 2, is strongly supported by Meat and Livestock Australia through its donor company, through AgForce in Queensland and the Queensland Government, as well as Crowe Horth, a national accounting and advisory firm. So they're all partners in what we're doing. We're joined by Damian, as you can see by his smiling face there, and a couple of quick housekeeping notions before I double check with Damian's introduction. For those of you who are joining on your computers, you will actually be able to attack that little drop-down menu and ask us some questions, and Dave is on standby in the background to take those questions towards the end, which we'll open up for. Those people who are on phones will regrettably be unable to pose questions to us, and we do this simply because we're well aware of limited line speeds, downloads and all of those sorts of things. Also, when we come to the end today, I will ask Dave to see if there are any questions which we'll answer. In addition to that, there'll be a short response survey at the end, which just gives us feedback on how this has all gone. So Damien, you can see your smiling face there. You're with the company Cape Advisory. You happen to be the chairman of our advisory board. As I've explained there, you're an entrepreneur and an investor in your own right, and you really love the idea of grooming businesses, which we'll talk about a little bit, for investors to enter. Is there anything that we should know about you that that will help set the scene for today?
Well, I hope I won't upset people, but I'm also a chartered accountant.
And I think I probably would observe there that you were one of the early people who were able to set your business up to be sold to one of the multinationals, and that was, I guess, one of your first entries into the whole investor scenario. Is that the case?
That is actually correct, yes, Gordon. That was some time ago now, but yes, it was to one of the big four firms.
Excellent. Well, let's get into it. The other thing that I always do is to set this up as well around our 12 pillars of business best practice. And every one of these 12 pillars comes into the development of thinking about investment. And that's the reason why the setup is here. So let me just quickly run through them in this context. An investor will always want the business owners to be clear on where the business is going. So that's where the vision comes in. Investors will find it attractive, which Damian will talk about in a minute, if there's a readily defined and clear pathway to market and there are some high value niche or market opportunities. Absolutely, they will be wanting people to think in a corporate manner about engaging with their investor and being able to report and organise themselves in an orderly manner. They will most definitely want a clear picture about the financial affairs of the business. They will most definitely want an insight into how the business is expected to perform in the future. They will also be looking at not only the business owners but also the people in the business and saying, can this business grow because the right people are in the business? Are these people disciplined and focused on where the business is going? Item 6, they will be looking for a systematic way in which the business is run, because they will be looking for the capacity for the business owners to become redundant. And the only way in which that can happen is if orderly systems are in place. Investors will also be looking for an appropriate approach to risk management and their legal obligations and legal positioning in the marketplace. They will be looking for an orderly process of succession, or what we call business transition and business growth, because ultimately they are part of the growth process now. They've become an investor in the business and they are looking for the sort of orderly approach in which things can be done. They'll also be looking at the ways in which we can engage with others, which is our pillar 10 about value adding and leverage. They will probably look favourably on something to do with alliances, and they will most definitely be looking for an engagement with the customer through sales and marketing and very orderly internal and external communication in the business. So Damian, before I leave that and move on to our agenda, is there any observation you'd like to make about those 12 pillars and their importance for people thinking about investment in their business?
Gordon, the 12 pillars capture, I think, the 12 most vital areas that a good managing director or CEO or owner-operator has to adopt and engage in vigorously in order to be successful, because any one or two of those not existing in their businesses will probably end up with less than optimum or alternatively mediocre outcomes. So I very strongly support them. I think they're very cogent, and I do think that they ought to be adopted, and look forward to hearing more about them actually.
So Damian, before we leave this, you mentioned the concept of high performing or mediocrity. What did you mean by that?
Well, given that we all know you're in business to have fun and make a profit, a mediocre return means a return that's probably less than, or it means it's less than optimum, so you might only be getting some percentage points above what you can get from the bank. That is complete mediocrity, and that's not why you're in business. And in fact, survival depends on growth, and survival depends often on profit reinvestment. Profit is not an option. You must make a profit to be able to survive and grow in the long term. So all of these 12 pillars that you've listed here play an important role in achieving an optimum return on investment. No one's interested in mediocrity, I don't believe.
Okay, and inevitably that return on investment piece is what they'll be looking for too, I'm presuming.
Absolutely, most definitely. It's the most important part of it.
Excellent. Well, let's move on to our agenda for today. And Damian, before we get into this agenda, there's another question I must ask you, which is, in the sessions that we've had with you previously, in the sessions that we have with Brett Collins from Crow Hawth, where we talk about financial fundamentals and financial operations, we always define who a potential investor might be. For the benefit of the listeners, could you just quickly define those potential investors?
Sure, Gordon. The answer, there are multivarious answers depending on size. So clearly we're not talking about a very large or a large listed company because the investors interested in that are normally larger institutions. We're talking about sort of small to medium-sized businesses, and these days there's a very strong hunt for yield or return from, in particular, private superannuation funds, high net worth individuals, often called angel investors, also on the hunt for yield. There are small investment syndicates around the place who are interested in investing in long term. I was in fact talking to one just yesterday who's very interested in buying land and leasing it back to agricultural owners and farmers, their return will come from a lease return. So there are lots of different high net worth individuals, superannuation funds, angel investors, and other mechanisms whereby people can raise capital, unlisted organisations such as the Australian Small Scale Offering Board, just to name a few. So they're essentially the sort of people who've got spare capital. They have a longer term outlook towards a return on investment. They're not looking for an answer in 12 or even 36 months. They've got a sort of 5 to 10 year investment horizon, and will definitely they definitely have an appetite for sustainable, not necessarily high growth, but growing businesses.
Excellent. So Damian, we've also talked about banks. We've also talked about the next generation or other family members. Any quick comments on either of those before we move on?
Well, certainly in the last 12 months, one of the key investment criterion is the knowing that the owner-operator and their family have a succession plan. That's actually been one of the requirements prior to investing, that there is actually a proper and satisfactory succession plan in place. In the ag sector, recent experience in the first quarter of this year, or since January, I've dealt with about 5 banks in the agri sector, and I must say they are enormously conservative as usual, with the loan to valuation ratios going from, in one case 50%, that was Rabobank, up to a maximum of 70%, subject to having satisfactory interest cover. That is to say that profit covers interest by at least 2 times. So normally, the norm is for an existing agricultural operator who wishes to expand into an area which isn't yet proven, they will probably stop at about 60% of the value of the land as the maximum amount of debt. Where you've been in business for more than 5 years, most of the banks will tend to edge up to about 66 maximum. In one case I came across 70. So it's a tough gig, because that means you have to have 35 to 40% equity in order to get expansion capital, which does make it tough for people on the land in particular.
So are we saying that those other investor opportunities that you mentioned at the very beginning of this this comment you've made, are they the ones who are likely to have a higher level risk appetite to let people do what they need to do, and there are some more novel approaches to repayments, returns, and approaches to building the business?
Most definitely, Gordon, because as we all know, the bank always ranks number 1 as a secured lender in any company or business. They get paid out first on if there's a wind-up or a sale or a default, and then following closely behind the secured lenders are the unsecured lenders, and including actually trade creditors, and ranking right down the bottom are the shareholders. So in terms of risk, the risk of a share is magnified compared to the risk of, say, a bank. Hence the need for a return. The banks, they'll receive perhaps today a 5.25, 5.75% return on their investment by interest, whereas an equity holder who's taking, or a shareholder, including the owner, who's taking far more risk, they will want double, triple, quadruple, whatever the bank's getting, just to be satisfied that their risk appetite is being rewarded. So yes,
Okay.
much more risk from an equity standpoint.
Damian, I think we'll move on, because these are the things that people can pose questions about, or indeed we can run another webinar to answer some of those questions as well. So I'm very conscious that time's going on, and I guess I made the decision to expand on who is an investor and what is their thinking around investment in order to provide some context for where we're going to today. So
Okay.
I've now moved to the slide regarding our agenda, and I guess in the discussion with Damien, we felt it was very important that people who are thinking of getting or attracting an investor into their business understand the characteristics that an investor will be looking for in the people who are actually running the business already. So we've set this agenda up around the notion that we need to understand the personal characteristics that we or other people in the business need to exhibit, which is item number one. Item number two is an understanding for business owners about the sorts of plans that an investor will be looking for in order for them to make that decision. And we decided also that we would very briefly cover off the time it takes to go down this path. So that's where we're heading to today. So let's just get started. Item number one was about the personal characteristics of the business owner. And interestingly enough, Damien, when I first posed this question to him, said it's about business owners understanding the sort of psychology that they need to bring to their thinking around an investor, the sort of psychology that an investor will look for in the business owner, and also the attributes to deal with some things that will unfold. And inevitably, when a business is in a growth phase, there will be pressure on the business owners and the shareholders, and that will test their capability or capacity for personal discipline to achieve the outcomes. And I've told this story before of actually a true story of a person that went to one of the investors that we put them in touch with. In fact, Damian was instrumental in this whole process. And this person actually made the call and said, look, while I do want investor funds, I still love to do my own thing. I still actually like to report to myself, and if I want to change direction, I want to do that when I want to do it. And so the decision was made collectively that maybe he was not the right candidate for, I guess, discussion with an investor. So Damien, I've got a number of points in there about sharing profits, investors asking questions, this notion of discipline, even the observation of somebody looking over the shoulder. Could you please elaborate on what this psychology concept is all about?
Certainly. Before I do, Gordon, I just want to say this, that two things. One is the path of true love never runs smoothly, and often it is the case also where ambitious, energetic, driven business owners all of a sudden have to share their part of their business, even it might only be 5 or 10%, with third parties. The preparation for that, the ability to deal with that, and the management of bringing in a third party is something that really needs a lot of thought before anyone signs on the dotted line. It really is so important, because when you think about it, the role of a board of directors is to appoint and motivate the managing director. And so if a business owner gets into bed with a third-party stranger, a shareholder, sure, they will vet them, they will go through their own due diligence and decide whether they would like to work with them or not. But down the track, things can arise where they can become very disappointed, and things often don't run smoothly. So one of the attributes you have to have, I think, is the ability to be able to coexist and be able to negotiate, discuss in a reasonable manner with third parties, who some of whom are actually quite difficult. I've dealt with some terribly difficult people. The other point I want to make before sort of getting into this, which sounds it's probably a little bit late to say this, but we need to be aware that the most expensive form of debt is in fact equity. The most expensive form of debt or capital is equity. So I think that before anyone is seriously thinking about raising capital, then they ought to make sure that they've fully satisfied or completed their debt investigations, because that is far more preferable, not only because you don't have to deal with third parties so much, but it's also a hell of a lot cheaper, because a shareholder, whoever they are, will receive hopefully a dividend return, and they'll hopefully receive capital gain. With the bank, they just get interest. The difference between the two, of course, is that with banks you have to pay the interest, whereas with dividends you don't have to pay dividends. You don't actually have to do that. So, okay, so back to the point of the personal characteristics. My observations are based on quite a long series of interactions with shareholders, owner-operators, and look, I suppose I have to say that the most difficult areas I've ever come across have been the characteristics, dealing with the characteristics of actually family businesses. They have a special place in business management because there's not just money involved, there's also emotion and sentiment. And so the person who's the managing director or the person who's the owner-operator must convince themselves when they look in the mirror that they really genuinely have that aptitude to be able to deal with strangers. Because although the strangers can be friendly, the necessary ingredients or part of the aptitude required is that you are accountable. Even if a person's only got 1%, you are accountable to that third party's 1%. Now maybe you're not that sort of person. Maybe you are, you know, fairly autocratic, dictatorial, and you're not going to listen to anyone else. Well, if you're like that, you should think very seriously about negotiating with third parties. So the desire or the willingness to be absolutely disciplined, to be responsible to third parties, to be accountable to third parties, these are all on top of the normal attributes such as, you know, obviously you're ambitious, you're hungry, you're hardworking. But I think the biggest one, and this has been a problem with smaller enterprises, not so much with larger enterprises, where, you know, you as the owner-operator, MD, you work your backside off 60 hours a week, you know, 53 weeks a year, and then at the end of the year, you have to share your profits with those strangers who've done nothing. They haven't got out of bed, and yet you have to pay them 5%. I've seen that from a psychological standpoint really cause a lot of damage to that owner-operator and caused, in this case, him to engage in action that he shouldn't have because he felt that they didn't deserve the percentage of the profits. Well, all that has to be sorted out well and truly in your own mind before you go near the sort of mechanical aspects of the grooming side of your business and the capital raising side of the business. So size does play a large determinant there. If you've got a 200,000 profit and you have to give away 50 to someone who hasn't got out of bed, you need to be happy that that payment is fair, it is reasonable, and it's really a return on capital, despite the fact that they haven't done any work for it. Because you know, your work, you should be paid a commercial salary, and the profit is really the super profit over and above whatever salary you've got, and you should be quite happy to share that with someone who's risked their capital. But a lot of people have that problem, Gordon. So
okay, so let's just recap on that because I want to move to the next slide. So I guess the key take-home message is an understanding that firstly there's a governance discipline which we'll come to, the notion of if a business owner pays them a salary, that's one form of reimbursement for their sweat equity or labour. Then the notion of having a profit and then a super profit is a different way of thinking. It's part of the psychology. Am I right, Damian?
yes, that's my view anyway.
Okay. So let's move on because this has actually set the scene well to go into this quite wordy slide, and I did that deliberately in order to ensure that people could have some take-home messages about the business owners and some of their characteristics. So I guess this is a different mindset. This is what we deal with in some of our mentoring programs, our business mentoring programs, to think, to understand or self-understand yourself and your own mindset, the way you do things. So the first thing was about the notion of you're a candidate for an investor. It's about being clear what can be marketed to the investor and define the opportunity in a very specific manner, and then set it up so that they understand it's being made available to them. And there are different, I guess, stages of business growth. It's about inspiring the investor so that they actually get what's going on and it's clearly articulated. that risk is understood, that there's good governance, which is something we do need to discuss briefly, Damien, and ultimately the notion of no surprises. So could you just take us through the concepts associated with the investor candidate?
Yes. Look, the notion here is that often when let's say companies in need or requiring capital, they often feel at a disadvantage. But the facts are that you can in fact negotiate with a venture capitalist or a private equity firm or a sophisticated investor. I mean, if they really like the opportunity, yes, you are a candidate from the investor's point of view. You're a candidate. You're probably one of perhaps 10 or 20 or 30 candidates. So clearly, the more preparation, the better grooming and better presentation of the opportunity will increase the probability that you'll go higher up the list of the investors' present, say, 10 or 20 opportunities that they're looking at. Because investors do constantly have you know, up to 100. I mean, private equity firms often have 100 on their desks at any one time. I was talking to a fellow this week who's got 13 on his desk this week. So therefore, clearly you have to, in whatever documentation, in your personal presentations, in your hard copy presentations, you must present yourself in the best light because you are a candidate. And equally, they are in fact a candidate for you as well, in the sense that if you don't like them or you don't like the terms, you're not going to do business with them, but they have to also shape up to meet your expectations. So yeah, Gordon's used the words actively marketing and selling to the investor. Well, certainly that's by way of, initially usually starts through introduction and then in a series of meetings. And yeah, you have to be thoroughly prepared and be on your best performance. Then we've got here a startup or mature business. Look, it doesn't matter actually. I mean, look, clearly the risks are far higher for a startup, but often the rewards are a lot higher as well. It doesn't matter what sort of business it is really. Preferably if you're trying to charge a very large intangible value, such as what you think the brand name's worth or the goodwill's worth or the opportunity's worth, you certainly have to be really well prepared to be able to negotiate your best price there.
So Damian, I'm keen to move on. I'm thinking, could you just touch on that good governance angle, and then because I'm thinking we've probably got about 15 or 20 minutes to go,
okay.
And there's a few other things. So good governance. What do you mean by that? Can we put it in simple terms?
Okay. So look, I'll be as brief as I possibly can, but governance is all about. I mean, investment is all about risk. Governance is all about risk reduction. You've mentioned it in the above point, managing risk. So good governance essentially means that you have administrative systems in place that minimise the likelihood of surprises, as you've actually mentioned down the bottom as well. So, I mean, how is that achieved? What are some of the parts? Well, look, elementary parts, as far as I'm concerned, they're sort of pretty much non-negotiable. Are essentially the management controls, such as if you must be on top of your cash flows, your profits, your balance sheet considerations. You must have a monthly meeting to gauge how you're faring against your plan. Which suggests you must have an enormous amount of preparation and planning prior to actually having a business plan and getting investor in. An enormous amount of preparation. My favourite actually, Gordon, from a reporting point of view, if you report monthly on these what we call a three-way forecast, which integrates the mysterious profit and loss account, balance sheet, and free cash flow into a document that makes sense. These are all aimed at risk reduction. Why? Because an investor will form their own view of risk assessment. They'll form their own view of what steps you are taking to reduce risks. They will want to know that you do have a fantastic strategy. What is your standout? What is your strategy? And converting that strategy then into a really well thought through business plan. Why do you do this? I mean, people often hate going to meetings, and you do it because if you have a sound governance plan in place, you will achieve, if you're selling, a much higher selling price, or from the point of view of taking on an investor, you will receive a higher entry price from an investor if you have a sound corporate governance plan in place. I could go on, but that'll do for now.
Sure. Well, look, that's actually the ideal entry point into our second agenda item, which I've just put up on the screen about number 2, your business and your plans. So Damian, you've actually probably covered a number of things there, and I'm going to ask you to elaborate, I guess, on the notion of that clear vision, the USD, which is the unique selling distinction, what makes you unique, the realistic nature of all of this, and I guess you've touched on this a number of times, which is the things that are required to make this business a standout, so that indeed it does come to the top of the heap on an investor's desk. So is there anything you haven't covered now that you'd like to elaborate on here?
Look, the first 2 docs would normally, I personally divide planning into strategic planning and business planning tends to be more short-term, operational based, whereas strategic, as you know, are sort of long-range planning and spells out the vision and the mission and the purpose of the business, what your unique selling proposition is. They're sort of all part of the strategy, and then the conversion of that strategy and vision and mission into realistic plans are contained in the business plan. So all those points you've mentioned there, and look, there's no actual recipe for a business plan, but essentially you have to cover the marketing, the operations, and the management control aspects of the business. I like to see, at the risk of sounding trite, I like to see, if there's a 100-page business plan, I like to see 99 pages about who's going to run the show, and one about the business plan. So the management aspect is what is going to make your business successful. So you have to be satisfied that you've got the wherewithal to actually execute on the business plan.
Okay, so let's just look at the next slide, which talks a little bit about that business owner, business plan notion. So we've talked in here about this kind of psychology thing. We've talked about the accountability and governance and that sort of thing, and those personnel issues. And then now you've raised the idea that if we've got a 100-page business plan, you want to find out more about the business owners. So that's really what this slide was about, and it's a very short and succinct statement of probably a fairly complicated matter. What would you say that's in there or not in there about that chunk of information in the business plan and information memorandum, which we'll come to in a minute, about the people?
Look, if you put 2 McDonald's stores in the same street next to each other, one will be far more profitable than the other, probably because they've got different managers. So your own self-assessment of your managerial capabilities, sure, we've all got gaps, so how are you going to fill those gaps? Training and education in business, I think, is hugely important, and it's a never-ending journey. But be honest with your self-assessment. Just don't get excited. A lot of people just get really excited when they want to buy businesses or set up businesses. They don't actually realise that a business is a ruthless game. It's absolutely ruthless. The bank won't come and be a good Samaritan until you run out of cash. So be honest about your own self-assessment. Make sure you've got your family on side. I've seen many occasions where ructions in the family have actually destroyed business because they've demotivated the person or people who otherwise would be running it. And so you must have your support of your family behind you. That's absolutely imperative. And be prepared in that third point there. Excuse me. Be prepared to adopt a very orderly and disciplined approach, and there will be pressures, so make sure you can be orderly and disciplined and have the intelligence to be able to make good decisions when you are under pressure. Bottom line, you must really do your own self-analysis before you spend 5 minutes on raising capital.
Sure, so it's about know thyself. And know the others in the business, their strengths and weaknesses.
An understated area, but to me it's number one at the forefront.
So let's move on to item number 3, because people have said to us, so let's assume that these things are done, the capital raising side of it, the mechanics. So we've talked here about some of the specifics about having someone like yourself involved who actually understands this intimately, understanding that if someone like yourself is involved, then there is actually a cost. There's also a preparation cost for getting these things done. So you've actually got to have some cash in the bank to get ready to set yourself up to be investor ready. And there's a big, quite often a significant time, and one of the things that we probably haven't talked about in here is distraction from the main game of running your current business. So could you elaborate on those points, Damian?
Certainly. Look, the first thing is that I think you should allow not less than 6 months to, as a minimum, to expect to be able to settle on a deal, whether it's a sale or an entry by an investor. Preferably 12 months. That timeline is impacted by the state of readiness of your business. How investor ready are you? And if you've got absolutely zero or minimal grooming plans and plans executed, I've seen the grooming process take up to 5 years. So 6 months is an absolute minimum, preferably 12 months. Like banks, investors hate people who are desperate in a hurry, because that usually means they haven't planned properly or made some huge blunder or something terrible has gone wrong, and they'll shy away from it. So the more time you allow yourself, not only will your business be better groomed, not only will your plans be better prepared, but you'll also not be rushing and put off investors who might otherwise be under pressure to produce, and they'll just shy away from that. Look, all those costs, they're all customised, Gordon. Look, on really small companies, I've seen it actually done for $5,000. They're sort of short form documents, but yeah, from 1 to 5 million, I would agree with your figures there. That's if it's an unlisted public company. It's because you're targeting sophisticated investors. You don't actually need a prospectus, which would otherwise cost you $250,000. So 25 to 100 would be not unreasonable, although it must be customised to the particular party's needs and structure.
Okay.
Yeah.
Yeah. I'm thinking we best move on because time's running a bit short. Damian, the thing I wanted to do was just very briefly recap on what we've done in that previous webinar, simply because participants here can actually go back to that original webinar by looking on our website, looking at the webinars and resources. So we're just going to very briefly cover the notion of the information memorandum, which is about telling the story, the grooming the business, which you've probably covered off reasonably well at this stage, and understanding the benefits of attracting an investor. So I'm just going to quickly run through those. So we put it like this last time, and I'd be interested in your thoughts on this information memorandum, which is we'll call it the statement. So can you just really quickly give us an insight into what we call an IM?
Certainly. An information memorandum is simply the document that you would give to an investor to attract capital, and clearly it must it covers administrative aspects, statutory legal aspects, accounting aspects, and most importantly the business opportunity and the marketing strategies, because that's a really good format. They've been around for a long time. They're called various things, but information memorandum is fine. Yeah, a well-written one will really cause sizzle. The document is aimed at attracting the investor, who will not necessarily make a final investment decision until he's done what's called due diligence. So you present your plan, you present your historical data, you present the brilliant marketing strategy you've got, the brilliant marketing opportunity, what you're going to do with the money, how the financial position is going to look, And if they're interested at that point, they'll get back to you and say, look, okay, love what you're doing. I'm prepared to, subject to checking the facts, because I adopt smart trust strategies. Subject to checking the facts, I'm looking at taking, I'd be happy to talk to you about a 25% shareholding. Once that happens, if that all goes to plan, you then sign a shareholders agreement with the party, settle it, and then get on with it.
Okay. So let's just keep moving along. So that was the last chapter in the book, is how we framed it up. We've probably talked to some extent about this kind of grooming or making ready approach. Is there anything just briefly you'd like to add to what's on that slide?
The last point, fast-track governance plan may be executed within 90 days. Look, that is true, but it does impinge upon the point you made earlier, Gordon, about interference with day-to-day operations. I remember when I was, some years ago, I prepared a company for listing on the stock exchange, and it took 12 months. But during that 12-month period, it did cause a lot of damage to day-to-day operations, and I was quite stupid, really, in that I didn't, or in that I allowed myself, to be distracted by this prospectus or capital raising document. And so the same with fast-track governance. Yes, it can be done within 90 days, but there is a potential opportunity cost there for the party who's going, particularly the CEO, MD, because it does take an investment of time that would otherwise be invested in perhaps growing markets or customers.
Sure. Okay, look, let's move on. The next slide we had was about benefiting of the benefits of grooming your business, and so my view is we've probably pretty much covered that off. So maybe we'll just pass on that one, and I'll go back to you, Damian, and say, if I give you the opportunity with this slide that says now what, are there any last words that you've got for people? I mean, given this has been a whistle-stop tour of attracting an investor into your business and some of the mechanics of doing so, do you believe there's anything that we've missed before we just touch on this notion of a one-day workshop in Brisbane?
Yeah, it's worthwhile saying that if the quality of information and the quality of opportunity is not up to scratch, it won't get up, it won't succeed. It has to be a genuinely attractive business opportunity run by seriously earnest, owner-operators. It is a hard process. People just don't open their wallets easily. It is a very tough process. So, you really need to take a deep breath before you engage in this process, because once you do, not only is there's no actual assurance of success, but you're also going to invest a lot of time and money. So you need to be very serious about it before you embark on it.
Okay. So we'll come to the questions from the floor in a minute and see if there have been any questions posed. And I guess we're exploring the idea of a one-day workshop in Brisbane on the 2nd of June. So to let everybody know that the notion there was to explore all these concepts in more detail. It was actually to bring along a couple of other organisations that we've worked with who do manage investor opportunities, and to look at it from the practicalities of the point of view of a person who's interested. So Damian, I think probably I'll give you the last word before we start to close things up and see if there have been any questions. So anything else that we've missed before we go to questions?
No, I think my earlier comments, I didn't want to put a dampener or anything, but the raising of capital to accelerate growth is actually a very exciting business strategy. It's something that doesn't happen very often in business lives, but it can be extraordinarily beneficial to a company that does have growth opportunities and market opportunities, but it can't fulfill because it lacks the capital. So I love it because of the optimistic of the benefits that can emerge from a properly structured deal.
Okay. Thanks, Damian. Dave, is there anything that we need to cover off in terms of questions before we draw things to a close?
There's been a couple, but I think given the time, maybe we'll just respond to those individually via email or in a follow-up email to to everyone that registered.
Okay, fine. Right, well, thanks very much for that, Dave. So just drawing things to a close then, we always reiterate what we're on about, particularly in our work in the beef industry and also the agricultural sector at large. So these webinars are part of just informing people so they have some sense of what's going on outside the square in the agricultural sector and also elsewhere in the food and fibre sector and other sectors. We run our one-day workshops programs, and the idea behind them is quite often family members and others just feel the value in having a day out and saying, well, look, we're going to go and work on our business for a day, become the outsider looking in. Just look at a stock take around where the business is now, where we want to take it, what are the things that we need to do. And then finally, we run a program called the 12-month CEO Mentoring Program. The name is quite deliberate in that it's about helping people think at a bigger picture level about how they're going to run their business in an orderly fashion. It's about thinking like a CEO. It's about being engaged with people like Damian and myself on a monthly mentoring process. It focuses on those 12 pillars. It brings together a range of specialists. It most particularly gets those business decision makers together in a room where for 2 days, 3 times a year, they actually have to do their own personal work on their business, because one of the biggest things that we find is people say, look, I'll get to that tomorrow. The problem is that tomorrow never comes. And the other beauty you can see on that slide is, which we find many, many occasions, is the interaction with like-minded people in the room. So drawing things to a final close, number of phone numbers on here. Obviously that's mine. Brett Collins is our representative from Crow Horworth, who's always happy to have a discussion about people's financial affairs, particularly around investment or around what we call the financial fundamentals. One of my co-mentors, Mark McNamee, that's his phone number there. And finally, Damian's phone number is down the bottom. So if anyone would like to give him a call and have a chat to him, most welcome to do so. And finally then, we obviously do the disclaimer side of things, which is it's really important for people to understand how this fits to their own personal circumstances. So Damian, before we gong off, I'd like to thank you for your time once again. Have you got any remaining observations before we conclude?
Think carefully.
Very wise. Thank you, Damian.
Everyone needs to think about their business. Okay, thank you, Gordon, and thanks for having me.
Yeah, thank you once again. Thanks, Dave, and everybody, thank you for your attendance today. We hope it's been useful. Probably gone 10 or 15 minutes over time, but I just let the things go. When you leave, if you're on the computer, you'll actually see that little survey bob up in front of you. It really helps us think about how we can do things differently and better. So please complete that if you don't mind, and we'll look forward to talking to you soon. And if you have any further questions, send us a note, give us a call. Bye for now.